So I'm going to introduce the panel, and then I'm going to turn it over to Katherine, who can take it from there. So let me introduce Katherine Blunt. Katherine's an award-winning journalist whose coverage of the Pacific Gas and Electric, or PG&E, situation won her a finalist status for the 2020 Pulitzer Prize and the Gerald Loeb Award. Along with her regular coverage of renewable energy and utilities for the Journal, her national bestseller and 2022 winner of the Golden Poppy Award for nonfiction, California Burning, tells the story of the fall of PG&E and the true cost of unreliable infrastructure. And if you haven't read it, I can't encourage you strongly enough to read it. Second, I'd like to introduce Stacey Doré, who is Vistra Corp's first and current Chief Strategy and Sustainability Officer and Executive Vice President of Public Affairs. Stacey led the effort around Vistra's most recent announcement earlier this month to acquire Energy Harbor's nuclear fleet and retail business, significantly increasing Vistra's zero-carbon generation capacity. Prior to her current role at Vistra, Stacey served as president and CEO of Hunt Utility Services and Sherryland Utilities. Before that, she was a senior vice president and general counsel for InfraREIT, Inc., an electric transmission and distribution company structured as a real estate investment trust from 2016 to 2019. And Stacey began her career as an attorney at Vincent & Elkins in 1997 after graduating with a degree in law from Harvard Law School. Our next panelist is Anthony Crowdell, Executive Director at the leading financial institution Mizuho Americas. With an almost two-decade background in utility analysis and stock calls, Anthony previously worked for KeyBank as an analyst and also at Jefferies & Company as a senior vice president and equity research associate. Prior to beginning his career as an engineer for Con Ed, Anthony received a master's in engineering from the City College of New York and an MBA from the NYU Stern School of Business. Next, I'd like to introduce David Springe, the Executive Director for the National Association of State Utility Consumer Advocates, better known to many of us as NASUCA. NASUCA's 60-member offices represent the utility consumers of 44 states, the District of Columbia, Barbados, Puerto Rico, and Jamaica. Prior to his current role at NASUCA, Dave served for 13 years as Consumers Counsel for the Kansas Citizens Utility Ratepayer Board, or CURB, and spent 9 years as an economist and expert witness for both CURB and the Kansas Corporation Commission. Dave received his MA in economics and JD from the University of Kansas, and he served as president of NASUCA from 2007 to 2019 and continues to represent consumer interests on numerous advisory boards, task force, and work groups. Clearly, there is a lot of work to be done. And last but certainly not least, I will introduce Christy Tezak, who is Managing Director of Research at Clearview Energy Partners. With 3 decades of experience in the electric utility and natural gas pipeline sectors, Christy is a true industry veteran and an expert in electricity and energy transportation. Christy leads Clearview's macro coverage of electricity markets, interstate pipelines, energy infrastructure, and U.S. environmental policy. She has served on the Women's Council on Energy and Environment for years and was its president for 2 terms. She is also a member of the Women's Energy Network, the Natural Gas Roundtable, and the Energy Bar Association. Christy previously worked at Robert W. Baird Company as its senior research analyst before assuming her current role 10 years ago. She graduated from George Washington with an MBA in finance before starting her career at Schwab Soundview Capital Markets, a DC-based research group, as its energy analyst. So you are also welcome to submit those questions online, and we will, of course, bring those up to Katherine once she has worked through her list of questions. So please join me in welcoming our panel. Katherine, the floor is yours.
Thanks, everyone. Happy to be here. I think this is going to be a really interesting conversation. We've heard a lot today about reliability, of course. And right now we're going to explore this in the context of the energy transition, with a focus on costs, how to manage costs, and what we might expect in this period of extreme uncertainty and volatility in the markets. And I guess to start, I thought that we should kind of level set and let's talk about how we should be thinking about energy costs. Clearly, it's been a very challenging year. There is still a great deal of uncertainty. Christy, how are you thinking about that at the moment?
Well, I think one of the challenges we have going forward is that looking at where we've been over the last few years, and when I say few years, I can't believe how many years Todd mentioned. I've been feeling kind of old. But if we look at the fact that we're coming off for a long period, we had a decline in the average cost of power, and that was given to us by the twin wonders of clean technologies coming down in price and still being competitive because they had additional government support, and to credit the natural gas industry on the producer side for following them down that cost curve. And so we had a lot of opportunity to see, the costs of generation come down, and that was something that customers liked. Well, when you're going full steam ahead into an energy transition, and you're looking at the idea of electrification, which is going to bring new demand when we've been shrinking demand. I mean, how many of us, I know you're following the electrics, flat is the new up, and that was the mantra for years, right? And so we're at a crossroads where we're looking at costs that are going to go nowhere but up. And the question is are we going to be able to make a value proposition that the consumer will feel that they're getting value for those increased costs? And so when I'm looking at costs, I see them going one direction, it's up. And then the challenge is going to be creating a value proposition so that the customer feels that they're getting what they pay for. If most of us are willing to go out and pay more for a phone or for a car to get more bells and whistles or other things that we perceive as having value, then if costs are going to go up, I think it's going to be necessary to convince consumers that not only are they getting a lower carbon alternative, but they're getting increased reliability and better deliverability in that product, because it's not just about keeping the beer cold and keeping the body warm, but it's not having my electricity bill be something that speaks to me every month in a negative way.
Yeah, absolutely. That makes perfect sense. Anthony, do you have anything to add there and kind of how that affects the business landscape and the investment landscape at the moment?
Yeah. So I follow like 36, 37 electric utility stocks, and so for us the big thing is we recommend stocks to large institutional holders, and investors like predictability and stability in utility investors. Those stocks typically trade at very high, what we call multiples, and investors reward very predictable, very transparent, earning streams or regulatory decisions and other things. What our concerns right now are that, as everything Christy mentioned, you have these headwinds of inflation, maybe higher commodity prices, higher financing costs. That's just adding a lot more pressure on the customer bill. At the same time, the utilities over maybe the last, kind of you said, it's a really long time. I've looked over 20 years of doing this. We've gotten used to spending a lot more capital. If you think of utility sector spending 2 times probably the level of depreciation for a product that's growing 1%. We got very used to very attractive earnings growth rates. And so what's putting a monkey wrench into that idea is that these high bills, you may see regulatory pushback. And so we're concerned about the growth rates in our space and wondering if maybe what utilities have promised investors may not be able to deliver.
And then a really challenging question that underlies all of this is, what is needed to meet the emissions reductions targets that are in place? What is needed to support the greater amount of demand expected to come with electrification? If you think about it in a 5-year period or even a 10-year period, how should we think about the true costs associated with doing that? And clearly there's so many facets of that. Does anyone have any kind of numbers or context that could be helpful in wrapping your mind around what that looks like?
I'm happy to take a cut at it. I think, well, first of all, it's important, I think, especially in light of these comments, to think about cost in regulated markets versus competitive markets. I mean, we are at the Competitive Power Summit. So I think there was just yesterday a Bank of America analyst report that came out and said that once again, regulated utilities bills have ticked up year over year, while their scores for reliability have actually gone down, and that is causing concern in the investor community about whether commissions will continue to allow them to earn the same returns while they're providing worse service at a higher cost. Words of the analyst report, not mine. But I think that highlights the difference where we've seen data showing that in competitive markets where customers are allowed choice, they actually have seen over time a lower energy bill, because as a competitive retailer and power generator, our shareholders are taking on a lot of the risk of these higher costs as opposed to just passing them through to ratepayers. So I think that's one important factor to consider when we're thinking about cost. In terms of the total numbers, there are a lot of different estimates out there, and it's really hard to kind of pin down what the true cost of the energy transition will be. I've seen reports from McKinsey saying that the global cost of the energy transition to get to net zero by 2050 could be $280 trillion. You see reports from E3 did a report for PJM pretty recently, I think a couple of years ago, and said that with existing state policies, which are kind of a hodgepodge in PJM, that they would be adding $3 billion a year to customer bills for the energy transition. Another source has been the International Energy Agency, which says that it could cost $4 trillion a year for the next decade to get to net zero by 2050. So whatever estimate you use, I think we can all agree that the cost of the transition is going to be very expensive. And I think that looking at ways to minimize that cost to consumers, we can't totally eliminate it. I think that's part of what we need to do is have an honest conversation about someone is going to pay the cost of that transition. And if it's government subsidies that enable it, that's still the taxpayer paying. So whether it's the taxpayer or the electric bill, people are funding the cost of this transition. It's going to be expensive. And my own view is that one way, there are lots of different ways we can talk about today on this panel, but one way to try to minimize that is to make sure that our competitive markets are robust and that we think about opening up additional markets to competition.
Mm-hmm. Mm-hmm. David, do you have anything to add to that?
Yeah, so I'm going to channel Travis Cavula here for a minute because I pulled these numbers out of a report that NRG did. But let's sort of level set for a moment. NRG put out a report that looked at New England ISO, New York ISO, and PJM, and they separated generation costs from delivery costs. And they looked at the period from 2011 to 2021, so there's a decade. So Delaware's residential delivery rates went up 78%. Maryland's delivery rates went up 88%. Pennsylvania up 74%. Now, the point of the report was that generation costs have gone down, and that was really great over that period of time, and it hid a lot of the increase in the actual sort of margin piece of the bill. But then we found out this winter that when gas prices go up, that just blows up, right? I mean, it just vanishes. And consumers don't understand any of this. They just know at the end of the day, their bills are going up. And there is political pushback. One of the comments that I think maybe it was Christy said this, consumers, I think I wrote it down here, consumers need to get what they paid for. Consumers don't understand the distinction for the most part, so the same kilowatt hours that were turning the lights on 20 years ago and turning the lights on 10 years ago and turning the lights on last week, it's the same kilowatt hour. It just costs 100% or 200% more than it used to. You're not going to explain that to customers. And you will see political pushback. I don't know if you guys saw the governor in Colorado, and I think it's kind of interesting because Colorado is obviously one of those states that's very out front on the emissions frontier, cleaning up the state, very strong EV policies.
Cannabis.
Yeah, could be that. But the governor issued a statement challenging all of his regulatory agencies and the utilities in the state to address the affordability crisis because bills had gone up so much this winter. Now, he didn't sort of separate the distinction that a good chunk of that, a third or more of that increase in bills has been policy-related margin increases, right? Some of it was gas prices that went up. Some of it was a very cold winter, so there was usage. And again, customers don't separate those things. They don't care. But there was enough of a blowback. There was a week of television news articles, day after day after day, blasting the administration. You are going to see that more. Great that gas prices have come down, but if you stop for a moment and just ponder any version of the energy transition that you care to, and there's 100 versions, and they all cost money, all of that money comes from consumers. Consumers, while they might have sort of an abstract idea of clean versus not clean, or we're trying to do climate versus not climate, that's about as deep as it gets for the most part. You are going to hit a lot of political pushback. And it matters. I mean, the same people that just arbitrarily say, we're going to have 100% EVs by 2035 are the same people that will arbitrarily tell the utilities to stop raising rates, right? Mm-hmm. These are the same people, so.
And so, as part of this conversation, what we're talking about a little bit too is speed and managing the pace of the transition and how that plays into the overall cost of doing so. And it's kind of a difficult question to frame, but given what we've seen, certainly, given the war situation in Europe, supply chain challenges, other things that are affecting an already very challenging pace of change, how should we think about the effects that that's going to have ultimately on the goals that have been set and our ability to effectively try to manage the cost of doing this in a way that doesn't have a total adverse impact on the consumer? I'm not sure who might like to try to take that. I know it's a big one.
We'll work down.
That's a tough question. I mean, obviously, I start from the base premise that the easiest way to stop rates from going up is to stop spending money. Let's just not do that, okay? So let's at least have a base that we start from and sort of a core philosophy. Don't spend money, rates don't go up. Now, obviously, we know that's not possible. Rates are going to go up. Speed is an interesting notion, and I've been sort of watching. And again, I run a national association, so I can't give you one answer, but I can give you 60. So pick. But one of the things that seems sort of obvious to me is that a lot of the big focus and big money is on doing big things, big transmission, big, we're gonna do big things. And I'm getting very worried that those things are just so far down. I mean, the length of time that it takes to build a simple transmission line. Mm-hmm. Simple transmission. I just saw that Illinois, I think, just approved part of the grain belt line. I approved or signed a settlement agreement on a certificate when I was the council in Kansas 10 years ago. That thing is still not even close to getting built, right? We can't build gas pipelines. I worry that there's sort of a focus on big and fancy, and where the money and the incentives should be is local, close, demand response, energy efficiency, solar, batteries, things that are near, because we can build those. So I worry that we're going to lose speed, in a sense, chasing the big, and really miss out on an opportunity to accomplish the small, which will have a much bigger impact. That's my kind of latest thinking. And I say that also recognizing that a lot of the middle of the country, there is very active movement out there against having land being turned over, zoning conversations and things to stop wind farms from going up, stop solar farms from going up, stop transmission lines from being built. So I just think it's going to be a very impossible task.
I would add.
No, please go ahead.
No, we're going to go down the road. You called it.
I would add, for investors, obviously the speed of the transition we like only because that's more spending for the companies, that's more earnings for the companies, that grows or helps out the stock price. But I think what we've noticed is, and maybe just a political dynamic we're in, is as Scott was hinting earlier, we've now labeled our states, blue states and red states. We've seen much quicker changes in the state house, and so that if one legislature or one governing body in a state wants to maybe get this transition done by 2030 or 2025, election comes up or election day comes up 3 or 4 years later, and the incoming party wants to change it now, and the equity investors are wondering, like, wait a second, is this project still good? Can we still recover the cost? So while the speed of change would be great and excellent for the environment and obviously excellent for equity holders, the message we're getting from some legislators is changing, or the policymakers, and I think it has equity investors really skittish on a lot of the change and the pace of change, which then brings us to, let's maybe do the smaller problems. And you could notice it on, if you have a boring life and do nothing and just listen to earnings calls from regulated utilities, they don't want to do any big projects because they're worried about getting the approvals. It's going to take so long. All of it's highlighted very small projects, and they always poke fun at the Southern Company book of big bets, and hey, there's no big bets here. So smaller pace of change, I think investors accept just because we're concerned at the risk or the regulatory risk of not getting recovery of it.
I think the visibility that you mentioned about it being local and what they can see, I think that's been part of the magic of residential solar deployment is, how offensive could a little blue panel be, and who doesn't like blue? It is visible, it is something that people can look at. When we talk about energy transition, so much of energy transition is in the intangible. It's right up there with investing in the bulk power system. I mean, it's like, what? I mean, total conversation killer at a cocktail party, unless it's in this room. But it's a challenge because it's what's visibility, and again, it's what's value. If there's regulatory pressure to keep the increase in rates at a regulated utility level somewhere in the ballpark of 4 to 6%, and if the reality is that the backstop provider is trapped in that range, then that's going to trap all the retail providers too, competitive or otherwise, in terms of rate flexibility. And I think that when you look at how you manage the speed, well, there is a tried and true way. We used to do it back when renewable portfolio standards were the only way to go, and that's, well, if all else fails, you do it higher and later. Problem is we've got net zero by date certain, so we kind of ran out of higher and later runway. But later is always going to be an option. The challenge is managing the political blowback, not from policymakers, but from this element that we're already observing. I mean, if you look at the fact that at CSIS yesterday, the administration's lead spokesperson for the decarbonization agenda, Ali Zaidi, was run off the stage and never made comments. And his objective is to be there taking the IRA message to the oil and gas community, because that's who basically funds the CSIS practice, focused on energy. There's a lot of support there from conventional energy. And it's like, well, what do you want? It's like, you're mad that Willow got approved, so now your objective is to thwart the administration trying to get conventional energy to buy into decarbonization. So if, this is one of the challenges in terms of pace, is every time, an administration that is trying to, like this administration, when it cannot move as fast as it would like and attempts to do something that is described as pragmatic, they're getting a ton of blowback. And the fact that we have an inability to build any bridges between the polarity of politics right now is something it's absolutely impeding the ability to do any kind of investment, because there is no faith that the pendulum won't swing back the other way.
Mm-hmm. I would just say that the pace of the transition is one of the key honest conversations that I think we need to have. I mean, that's the key to the transition, is really having intellectually honest conversation about what's possible, what's affordable, how do we solve this trilemma that someone referred to this morning of sustainability, affordability, and most critically, reliability. And for companies like ours, we don't get a guaranteed rate of return. So just spending money to spend money because we know we have a certain ROE is not how we make investment decisions. We make investment decisions based on shareholder returns. And so that means that our markets need to send the right price signals to build the kind of generation that we need for this transition period. And I think your reference to the crisis in Russia and Ukraine and what that has taught us is that Europe moved away from nuclear, for example, and some other forms of generation to try to go too fast. And they found themselves captive to Russian gas. And I think that is a lesson, it's an object lesson for all of us, that gas is an important part of our transition, and it's needed, as many people have said on the stage today, to be a backup to the renewables that are going to be built out. I mean, they're going to come because there are government subsidies for them. And in fact, gas is basically the only form of generation at this point that doesn't have a government subsidy. So, but we do still need to have the right market signal sent to invest in our current generation to stay on as long as it is needed and can stay on. And frankly, we have conversations about whether there's new gas that needs to be built. And we look all the time at whether it's economic to build new gas plants. And in most markets today, it's not, because the investment signals are not there. And so if we want to have, an honest conversation about what is the right pace and what is the all of the above strategy for getting eventually to deep decarbonization, then I think we have to talk about investment signals, we have to talk about demand response, we have to talk about all the different methods of getting there. But we also have to be realistic about what the goals are. I mean, just last week, I don't know if folks saw, but the EIA issued its 2023 Clean Energy Outlook. And this is, a government-funded agency. And while the Biden administration has announced that the IRA, when they passed it, that it would help the U.S. reduce carbon by 40% by 2030 versus a 2005 baseline, which, by the way, is still 10% less than the Paris Accords require. The EIA actually came out last week and said even with a high tax credit case, so they basically assumed that all of the energy projects that are qualifying for these tax credits can get the maximum credit. So that means they have to meet the wage and apprenticeship requirements, they have to meet the domestic content requirements, they have to meet the energy community requirements. So even if they do all of that in the high use case, we would get to a 34% reduction by 2030. So I think we have to be realistic about what the goals are. We have to make sure we're having an honest conversation about how to marry all these things together. And I really liked what Todd said this morning about, all of us need to own that conversation. Not just those of us with the reliable, dispatchable assets, but everyone who's a generator, a retailer, a regulated utility, a competitive company, all of us who are producing, selling electricity, building transmission, everyone who's in this chain, we need to own that conversation together so that we can come to the right solutions.
So in talking about managing the pace of the transition, reliability is a real challenge and a real risk. And I think we're already beginning to see that. There seems to be a consensus that's going to get more acute as the next several years wear on. The near-term challenge is very real. And Anthony, I'm curious if the investment community is beginning to talk about this any differently, kind of given after some of the events that we've seen over the last several summers or even the winter, as it relates to evaluating companies.
Especially for like regulated utility investors, the reliability thing does come up, but I feel like if you just look at the companies in our space, they've all done their best to get out of anything that's going to be market-based. Whether the policymakers or whatever have not compensated them for that risk, the utility investors cannot handle that risk. They just, right away, they're getting out of it. And so if you just look, I know we spoke about the Vistra acquisition earlier of the nuclear plants, but they're now backed by IRA and are given a government subsidy. But most of the companies over the last 10, 15 years have gone out of any type of generating assets that are kind of market-based. And so that they understand there's a reliability problem, but the companies that are out there trying to help solve that are not regulated utilities and more merchants like a Vistra or an NRG. And those names, those stocks trade at a much lower multiple because investors are not sure that the policymakers will compensate them for that reliability. I mean, we always seem to have these conversations. I think after the polar vortex in Ohio, I want to say that was like 2015 or something, fuel mix was a big thing and solid fuel, having it on in bunkers. I remember the year because I actually I live in Staten Island, New York, if the accent didn't tell you, but I decided to put a backyard ice hockey rink, and it doesn't get that cold in Staten Island, so my wife was like, you're an idiot, you're going to get like 3 days out of this. I got 3 months with the polar vortex, so there was some benefit, but with the getting back to work and the thought being, solid fuel and reliability, that just came and went. And so now we went to Winter Storm Uri. Texas, we're going to talk about maybe what they're going to do in Texas to really upgrade the system, winterize it. And that came and went. And, talking to Christy before, then she said, even the gas producers really have to get away from saying the wellhead froze and we can't deliver the gas to the power plants. I mean, we've all seemed to come up with excuses and maybe like owning the conversation, as we said before. So utility investors or equity investors seem to not think that they're going to be compensated reliability. And while they may be having that discussion, they're not putting their money where their mouth is.
Mm-hmm. If I could just maybe address that a little bit as well. So first of all, we are very excited about our Energy Harbor acquisition because we believe that the reliability from that, the additional reliability from that acquisition actually comes not from government protection on the downside, although that is certainly there, but it comes from the fact that nuclear is the only zero carbon form of dispatchable 24/7 baseload generation. And so there has been an increased interest in nuclear in the investor community and really around the world as a result of kind of highlighting the need for dispatchable generation while at the same time achieving our sustainability goals. We have solar and batteries, as do many regulated utilities and folks in this room as well, and those have been getting government subsidies, solar at least, and wind for a long time. So I agree that the market is not necessarily always sending the signal for reliability in terms of rewarding those of us who are willing to put our shareholder dollars at risk to build dispatchable generation instead of getting a guaranteed rate of return.
It's a nice segue into what I was hoping to ask you next. If we could even unpack the strategic significance of the Energy Harbor acquisition a bit more, I think that would be great. But also, you were mentioning earlier about constantly evaluating what it would take to potentially build, for example, new gas. I mean, what sort of market design changes or signals would be needed for you to ultimately decide to pull the trigger on that?
That's a great question, one we get often. So first of all, on the transaction, again, we're really excited about that transaction because it does allow us to really grow our zero carbon portfolio at scale, which is hard to do when you're a generator like us that has a very large thermal fleet too. And that thermal fleet continues to be critical for reliability across the country in all of the markets that we serve. So it's a very, very valuable part of our business, although investors don't always value it the same, as Anthony mentioned a minute ago. The strategic rationale really was that. It was how can we grow our business in a way that is consistent with our sustainability goals, because we have announced a target of reducing our emissions 60% by 2030 compared to a 2010 baseline, and we're, I think, about 2/3 of the way there already. And so we want to continue to advance our sustainability goals, but also really provide reliable power. And reliability, frankly, is our highest, objective, because that's what's important to our customers, and we want to balance affordability and sustainability with that, but it's very important to us to be reliable. And so this transaction allowed us to really highlight the value of both segments of our business. The thermal side of our business has, a 95% availability, performance, very safe, and continues to provide that base load power that all of our grids need. And then on the Vistra Vision side, which we've labeled our zero carbon portfolio going forward, we have solar and batteries. We have the largest battery in the world in California that we're actually expanding to 750 megawatts this year. We have the largest operating battery in Texas. We are doing coal to solar in Illinois, where we are taking up to 9 of our either retired or to be retired coal sites and putting a mixture of solar and batteries there. So we are advancing our sustainability goals, but those projects of solar and battery, it takes a long time to build enough of those kinds of projects to really scale up your zero carbon business. And so we saw this transaction as a way to do that quickly and to take advantage of the kind of renaissance in nuclear power. Mm-hmm. In terms of the market design question, we are consistently having those conversations across the country. ERCOT, PJM, CAISO, they're all having some form of conversation about what are the market incentives necessary to maintain and incentivize new dispatchable. And I think for us, we have some general principles. There's no kind of one-size-fits-all solution in our mind because every market's a little different. We do believe that incentives should be technology neutral because, again, we should be incentivizing dispatchable as well as renewable generation because we need a mix of both to remain reliable. We think that, things like market caps or trying to adjust capacity accreditation in a way that disadvantages dispatchable generation are interferences in the market that are going to scare investors away. We think that, we simply need to set price signals in a way that if you talk to the economists, which I'm not one of, but we have ones in our company, it ought to be, in theory, it should be a fairly simple matter of looking at what is the cost of new entry, setting the right demand curves, and then compensating investors for what you think it will require for them to build for a 25 to 40 year timeline. The problem is that we have so many changes in our market. Every time the legislature meets, or every time the commission meets, or every time FERC or one of the ISOs meet, it seems we are talking about different tweaks to the market, and that just injects a lot of uncertainty for investors. And so you're kind of, the ground is always shaking beneath you a little bit, and you're trying to decide at what point is the right time to invest. So I think stability, I think just simply offering, shareholders a return, a reasonable return on their investment, and making sure that we're not doing arbitrary market interventions like market caps or retail market share caps, that sort of thing. That's not going to incentivize investment.
A huge challenge that you just spoke to seems to me the challenge of coordinating among all of the many stakeholders involved in market design, planning, policy making, setting emissions reduction targets, whether they be at the state level or the federal level or anything else. And Christy, I'm curious how you view this challenge and whether there's been any greater meaningful conversation about how to better manage it as managing the pace of the transition becomes more challenging.
Well, I think Jim Robb started the conversation this morning when he suggested the heretical idea of significantly revisiting the structure of, what the RTOs are doing in terms of capacity markets. And, I do wonder if the heavily specific term auction idea that was, at the heart of RPM and the base residual auction is a vehicle that's been overtaken by a number of disasters, not of its own doing. But if we're looking at the necessity of investing over a longer term in technologies that may require time to be demonstrated, or if you have to have a couple of projects get online before anybody makes any money, and those sorts of things, we moved away from a real portfolio concept in terms of procuring capacity by focusing on trying to perfect an auction that we could add a lot of character, attributes to, and all of this other stuff that David's folks go, I'm buying a what, and I think that's, if we're looking at long-term energy transition and we look at where, what Manu mentioned with the PJM report, it's like we don't have a problem today, okay? Nobody, I think, was hugely surprised by the rest of RTO price, other than disappointed, but no one was expecting it to clear at $100 because of what we're going to see in 2027. But if we want to see assets come in 2027 through 30, and we want to convince ourselves that we can manage the transition and we should maybe be slower or faster in terms of exit, the auction may not be the best vehicle to get us there. And it's heresy to mention in this room, with the exception of probably one or two people who know me well enough that I've vented this in private, but I think rebundling some of the capacity in the long-term procurement with the development of projects that Vistra is bringing to market, that LS is bringing to market, that members of the American Clean ACP, American Clean Power are trying to bring to market, and coming to grips with a fair accreditation and assumption for what that capacity is, and starting to integrate that, because the capacity market doesn't have to be limited to the auction. I think to build faith back into markets, we may have to step away from defining them solely as a terrifically functioning auction in the eyes of an economist. Because it isn't how we buy anything else, and it's not how we're buying the energy going forward for this transition. Because we're talking about PPAs, we're talking about lead time, we're talking about interconnection queues, we're talking about all of that stuff. And the perfect, well-functioning auction that we had for a couple of years seems to exist in a parallel universe to that. And I think that having the conversation about, is it time to take the plunge of talking about not doing tweaks, but doing bigger changes and what that means. And that's hard because investors don't like uncertainty. And many of them, especially with income-bearing investments, really dislike change.
You wanted to...
Well, I was not to get into a giant philosophical discussion, but I think what you were describing was a vertically integrated utility.
No, not necessarily. No,
It
because
sure sounded like it to me. If we bundle a bunch of stuff together to
No,
make
'cause
sure that
they'd
we get what
really
we need and
rather
we have
do-
enough revenue to make sure that shareholders get taken, we create the administrative constructs to make sure that happens. Sounds like a
no,
vertically
competition
integrated
for
utility.
PPAs, I think actually is not a bad way to go, and so it doesn't have to be vertically integrated, because I think that you can have quality competition in the generation space, and you can integrate innovation more aggressively, but you can make the utility investor feel better because it's easier to pass through a PPA than recover a bad investment that you own. So no, it doesn't have to be completely vertically integrated, but
We're a competitive market thing.
well, the competition can be for the PPAs, instead of everything in spot. And so, when you're looking at the fact that PPAs exist, I mean, they are the underpinnings of the renewable portfolio standard of so many states.
Mm-hmm.
Go forth and procure. Even on retail providers in a competitive state, thou shalt procure a certain amount of your power from a low-carbon resource. So if that's what's happening, whether or not the market operators want it, then the question is do the tools that the market operator has have to change? And it seems to me that we're starting to see more and more of a business case for contemplating that kind of change and figuring out how to better support the assets that are still incredibly viable and rank them in terms of which ones should go first.
The only comment I would have to that, Christine, without a longer debate is, I think when we hear a lot of people, not just you, talk about, maybe it's time to take a new look at markets. But the premise is that that the functioning market is no longer working. The problem is we're not allowing the markets to function the way that they were designed to function. So I think if we were allowing markets to function the way they were designed to function and not, interspersing these kind of arbitrary regulatory decisions that are supposed to be not made in a competitive market, then I think we would see the benefits of that come to pass. So I think it's a little bit of like we're starting with the wrong assumption when we say let's look at changing markets. Let's actually just go back to letting markets function without offer caps and other types of regulatory interventions that don't make sense.
Can I add a different layer on top of that? And I don't think I disagree with you, but one of the things that seems obvious to me sort of post Winter Storm Uri and Elliott, and we kind of keep coming back to this, and I'll tell you up front, I'm not sure this is ultimately going to be price favorable to consumers. But, I think we talk a lot of administrative constructs to get around the fact that we just don't do contracting right. Firm is firm. If you are bidding firm, that's your contract. If you don't show up with it, you're on the hook for the market price of replacing that power. If you are buying gas to supply your power plant and it's a firm contract, that firm better show up or you're on the hook. Or that risk needs to be transferred down to the gas supplier so that if they freeze in, they can't claim force majeure. I mean, just the whole idea that, especially this is more of a gas side than electric, but the whole idea that a gas supplier can claim force majeure on a product that they sell that is majority used when it gets cold, and you're going to claim force majeure because it got cold. Yeah. That's just bad contracting, right? So I think again, my old economist hat's coming out, but I feel like some of the problems that we see in the markets and getting the price signals that you may want, even though my people may not want them, comes down to like getting contracting right, getting the risks allocated correctly, getting the penalties for screwing it up correct, and not having those penalties just sort of default down to customers, because that's what happened in Uri for the most part. You talk about ERCOT and $16 billion of ERCOT costs, but if you look at the gas cost in the entire middle of the country, it was another $20 billion. Oklahoma Gas and Electric spent 5 years of consumer gas costs in 3 days, and they're going to pay for that. Consumers are going to pay for that for the next 30 years. They bought a house, a very expensive house, for 30 years because the gas market melted down, and there's no way to sort of allocate those costs along. And I know we can get into a philosophical discussion about who took the risk in ERCOT, but that said, and I did notice, it's fun to be here in Vistra. I'm sure, I'm fascinated to see the Fifth Circuit decision that said the commission can't arbitrarily raise the price to $9,000 $100,000. So that's sort of a fun little tidbit that's going to
I
be a
was gonna say,
regulatory conundrum. But I'm just saying, there are some other underlying things that I think we do poorly, and I think it's done poorly because there's a regulatory system that doesn't function well, and state commissioners that don't hold people's feet to the fire, and federal commissioners that don't hold feet to the fire, and boards at RTOs that don't get stuff done. I mean, there's sort of an underlying level of things that probably can be fixed.
I just have to, I can't resist in response to one of the things David said, just pointing out that, Vistra was the first retailer in ERCOT to announce very shortly after Winter Storm Uri that we would be protecting our customers from the impacts of Winter Storm Uri. And so we did lose over $2 billion, but that was not passed along to our retail customers. I'm not saying customers in Texas didn't get some sort of impact from securitization and other types of costs. But I would just point out that that's another benefit of competition, because our shareholders do take the risk, and they certainly did, as I know many others did in ERCOT in that storm.
Oh, there's so many different directions I want to take this, okay? I mean, risk allocation and cost sharing is just something that's like so integral to any conversation about this industry, right? And it's like, what is right, what is proper, what is prudent, and like what are the long-term consequences of any decision that is made? I mean, Anthony, I'm curious from like an investment standpoint, kind of how, especially as you kind of see some of these more extreme events that have the potential to be quite expensive for both, either whether that be investors or customers, sort of how you see the need to thread that needle as we continue to move into a period of greater uncertainty.
So obviously, when you're a shareholder of one of these stocks that's impacted by this storm, I think there's an old saying, there's a ratepayer born every second. So you're looking for that. I mean, it was pretty brutal if we just picked on Winter Storm Uri and kept with the conversation. I mean, because I think some of the companies came out and the Wall Street trading houses were like, hey, this is benefiting one of the retail providers and it's hurting one of them. And then somebody said we thought we made $1 billion and then switched it around. We lost $1 billion, and the equities were just going all over. So obviously, for shareholders with little risk appetite, we'd like all of the cost to be recovered through the ratepayer. I mean, we're looking for we're not really that generous of a group, and we're not looking to share any losses.
Funny, I feel the same way. I'm not feeling generous at all.
No one's feeling generous at that time, and it's just, we're looking for, we rank states, we go through all this where the ability to recover their costs, especially during a winter storm, as you brought up OG&E and the huge gas cost. And now they're going to securitize that over 30 years. And people who are going to pay their bill were never around, were not around when they used that gas. And so for equity investors, we're looking for, more stability. But it just seems that, and again, beating a dead horse, it's that when you think about maybe regional markets, their concerns are different maybe than the actual individual state and who's really supporting that. And so if we just picked on PJM, their view is maybe the whole family of all the states involved, but a legislator or regulator to pick on Todd in Ohio may just have a different view, and it's just the equity holders trying to balance that view and see where it's going. But equity investors love when ratepayers pick up the cost, right. Yes.
Can I make a ploy right now for building all of this infrastructure that we desperately need with 100% debt? Because that's the cheapest, hands-down way to do it. Just saying.
Yeah, I'm even putting aside some of these very extreme events, which of course we really can't because they've been so consequential and loom so large. But even just in general, when we're talking about the day-to-day provision of power, at this point, if we're moving into a period in which costs are going to continue to go up, how do we define affordability now? What does that even mean? I mean, I think the notion of that is beginning to change, seemingly in a real way. And David, I would love to hear your thoughts on that.
Oh boy. So.
It's a fastball right at you.
I know. It's like we only got 20 minutes left.
Yeah.
No. So it's a little bit of this is sort of affordability is a little bit of a hobby horse of mine right now. But just a couple of quick facts. I mean, according to the U.S. Census, 64 million people live in households lower than 150% of poverty level. And if you get to 300% of poverty level, that number more than doubles. If you look at the need for energy assistance, the National Energy Assistance Dealers Association, they're seeing more applications than ever. There's a great problem and a disconnect between the cost of energy and the ability of consumers to pay it. And everybody puts affordability in that sentence. We want reliability, we want affordability. Very few people actually legally or structurally have defined what that means, or even obligated, and that includes state commissions. So this is why this has been bothering me. Most state commissions, who are the ones that ultimately have to deal with the affordability question, because they're dealing with the retail bills, their statutory structure has sufficient and efficient service, just and reasonable rates. They have some formulaic sort of thing. Very few actually have the word affordability in them. And there's this argument that says, look, prudently incurred costs, if they're prudent, go onto the bill, and the rate is what the rate is, and to say otherwise is unconstitutional. So where does affordability set in there? Very few states have actually taken the effort to define what affordability means. And I'm not going to tell you what I don't know what the answer is, but I think that there needs to be a very specific process to define what that is, whether you have it in your statute or you don't. We have not spent enough time with that question. And sometimes it's sort of the fascinating thing to me is, and this is kind of across my membership, some states are trying to wrestle with what affordability means, and that comes into play it should come into play while you're planning, not after they've built an asset and have come to bring it into rate base. So you've got to have some concept, and you've got to define your metric, and you've got to do it up front. A lot of states are sort of skipping past that and just going, well, we care about the customer, so why don't we design some sort of rate that will help? So there's percentage of income type rates. And I'm not saying those are good or bad. It's sort of a novel theory of rate making, and it does need legal support because there's a non-discrimination clause. But what if you're in the group just outside of the group that gets that percentage of income rate? Because those are getting collected from somebody, so you're just shoving costs uphill. So I maintain that if you have the ability to make decisions based on affordability, and it's interesting. I think it's an interesting conversation maybe to have on the competitive side, because you're just sort of internally. I've heard it come out of your mouth several times, but ultimately, how do you define it? What is it? How do you enforce it? And how does that play against your shareholder needs to build, earnings over time? So I think it's a conversation that we really need to have more now as we start looking forward and planning, and it works into the transition, right? What are we going to build? What is our priority? What is our affordability metric? How many things can we actually build and stay within that affordability metric? That has to be part of the decision profile now, not something we just say as one of the triumvirate of sufficient, efficient, reliable, sustainable, affordable. Affordable makes us feel good, but I want you to stop for a moment and think about what it actually means. And I'm not going to tell you what it's. A lot of people look at some sort of, household energy burden, household income, something. But you can't spend. I think AEP announced like a 5-year, $22 billion capex with a 8% rate base year-over-year growth rate. You're never going to stay affordable with that. But if you haven't defined affordable, it sure makes it easy. So it's kind of one of those, regulatory places where I live, and I know this is a competitive conference, and I'm on sort of the retail end of this, but I just want to drop that out there and get people thinking about, if you say affordable, what does it mean? Do you have the legal backing? Have you gone through the process of defining it? And are you using it as we move forward and think?
Well, it's a lot to chew on. Did you want
Yeah,
to
I was going to add, it's weird. If we looked at it as, equity investors, we always thought affordable was anything a single-digit increase. Mm-hmm. And so for the longest time, we said, hey, Con Ed's going to ask for a 9% increase. That'll get whittled down, whatever, they'll get it approved. And then we went into, beginning with the inflation push in 2022, we thought companies would struggle getting increase, that it was double-digit, and so far we haven't really seen this pushback. So what we once thought was affordable was anything below a 10% increase. I think there's numerous cases pending in all states that are greater than 20%. So it seems that policymakers, utilities, everybody involved, maybe then other than the consumer, looks like they're willing to accept, north of 10% increase is affordable. Mm-hmm.
I think Anthony's making my point about why competitive markets are better for consumers, because I think, we have a retail organization that's done a study showing that since between 2008 and 2021, in the states that have only monopoly utilities, regulated utilities, they've seen a 26% on average bill increase. In the states that have competition, we've seen a 2% decrease. So I think the data shows that competition works for consumers, maybe not as well for investors, but we have investors in our company that are interested in the investments that we make in the transition and in reliability, and doing it all in a way where we try to keep it more affordable for customers. So it's very hard to define affordability in absolute terms. The Bank of America article I mentioned that came out yesterday talks about it in terms of wallet share. So in other words, the percentage of basically per capita personal income that is taken up by your electric bill. And even though that article notes that for the however many years in a row that has gone up for regulated utilities, it still is something like 2.5% of wallet share. So I think we have to ask ourselves, what is the value of electricity? I mean, it's a necessary good. The public seems to agree, and policymakers certainly agree that we need to do it sustainably as much as possible. So there is going to be a cost associated with it, and the question is, how can you best mitigate that cost? And I think that's a combination of competition and pace.
Well, I think the challenge in all of that, trying to bring those ideas together, is the fact that the word markets often comes in the same breath as volatility. And that's something that doesn't necessarily resound well with consumers and tends to get policymakers exercised. And I think that's one of the challenges, is that when you look at, what happened in Uri, the market responded. You'll be paying for that market response for 30 years. And I think that that is part of the challenge, because when you have these very large and acute events, the average performance of competitive entities over time gets overwhelmed by that noise. And that's, I think, one of the challenges that the weather issues that we've had over the last several years is it creates this huge, ugly event. And the average performance just gets swamped by that. And I think that's part of making the sale of when markets and competition are working, is that what's the value? And if a good track record, over 5 years gets blown up by one event that takes 30 years to pay for, then it's really hard to make the sale to David's members that that was a good idea, and maybe we just should have planned and had everything on the table ahead of time and agreed to what it was and lived with it, whatever the impact was.
Yeah, I mean, I think the extreme weather events are certainly challenging for everyone. If I recall correctly, in Elliott, it was actually the regulated utilities that shed load. So I agree. I mean, I think extreme weather events are very challenging for regulated and unregulated entities.
The Southeast guys should
Yeah.
look. Sorry, we were so on the PJM channel all day.
We're all in on PJM.
Well, we have 10 minutes left and a number of very interesting questions. Let's see how many we can get through in the next few minutes. This is kind of interesting. How do you educate consumers on the avoided costs of energy? Which I guess could be interpreted a number of different ways, but.
Next.
What?
Next.
Good luck with that.
Does anyone have any thoughts on that? No?
Yeah, I did. Well, I mean, the consumer education question is always vexing. And being a consumer advocate, of course, we're very interested in educating consumers. And it is so hard to get to them. I mean, literally the vast majority of customers couldn't care less. Mm-hmm. Just aren't interested, don't want to know. And then there's the question of what medium do you use to try to even get to the ones that might care in any sort of magnitude. And then talking to them about something like avoided cost. I mean, yeah, that's an us conversation. That's not really a, I mean, there are 10 consumers in a room that maybe will engage with you on that, but that's.
Yeah, it's tough. So the next one is, how do you reconcile the state policies being mandated with the political pushback from consumers on higher prices? Isn't that an irreconcilable position?
Welcome to power markets.
Yeah.
Welcome to the electric sector. Thank you.
Well, there's an interesting thing, there's always this lag, right? So if you're a policymaker, you can declare anything you want, because by the time we get around to getting there and those rate impacts, something gets permitted and approved and built and into rates, it's years later, you're gone, right? So there's no risk to say, we saw this, when wind was coming on. Remember, it was, we're going to do, 20% renewable by 2020. Totally arbitrary number. It just sounded cute, 20 by 20, right? But by the time you got there, it was pretty darn expensive. And you're seeing the same sort of thing with EVs, right? We're going to have, 100%, electric EVs by this date. We're going to continue our emissions down by to 2030. The people that are making those decisions at the political realm aren't going to be around for the results. There's no risk to them. And I don't know how you turn that risk into a current conversation.
I do think, that E3 study that I mentioned earlier that was done for PJM, it was on, kind of the lowest cost of decarbonization. And one of the things it notes, and I think this is well understood, it's just not politically popular at the time, at the moment, is that carbon pricing is really the best way to decarbonize and to do it in a way that is affordable for the customers who need it the most. And that has been established by numerous experts. And so and we're a member of Americans for Carbon Dividends and, those organizations that tout that, but it's not politically palatable at the moment. But if we really, again, if we ever get to the point where we can all have a very intellectually honest conversation about what's going to work the best, carbon pricing is what's going to help to, as best we can, marry up these kind of competing priorities.
Yeah, that is interesting.
Katherine, one thing I'd add to David's comment, it's interesting for any state regulators in here, and former state regulators, I know there's a couple of you in here, you probably got badgered by guys like us trying to get a visit to talk to you and find out what your policies are, and we bring a bus full of aliens from Manhattan or hedge fund people to talk to you. It seems that the last 12 months, that trip is mainly to state legislators because the regulators, I think, understand that delicate balance between utilities, shareholders, and consumers, or they understand the best of the group, but yet the legislators or the policymakers are just coming out and saying something and like, whoa, this has huge impact to this utility, and now I see myself trekking more towards meet representatives of this district or that district, and I don't know if they appreciate how much their rhetoric is impacting at least the utility stocks.
We've been kind of tiptoeing around this question all day. Is there a tipping point where customers stop accepting rate increases associated with all things clean energy? And I'll take that a step further and say, if so, then what? What do you do if there becomes a point in which that happens?
I don't know that we get the option of not accepting,
Right.
right? That's sort of the problem of the
That's the
process.
problem. Yeah, you can't stop paying for it
'Cause
necessarily.
that'd be a great legal position for my people.
Or even if the pace slows down, then you have the political blowback of, we're not addressing the existential crisis, people are dying in the streets and all of that other hyperbole, and that's not constructive. And I thought that, when Stacey says we all have to own the conversation, there needs to be ownership and participation in an adult fashion from the extremists on both sides. That means those who don't even think that, emissions are a thing, to those who believe that if it doesn't stop tomorrow, their anxiety is going to be the end of them, and everything in between. And that's the problem, is that until we get some sort of willingness or ability to see political victory and bringing people together instead of driving them apart, we're just going to keep falling, muddling, managing, and nobody's going to get what they want.
Can I add one more thing that I think is in part of the honest conversation piece? and not all of my members are excited about this conversation, I can assure you, but I think that it's time that we really need to have a much broader discussion around retail pricing and what price the consumers see, and figuring out how to match that up with when assets or resources are dear or not dear. And again, it's sort of the simple, if you explain to an EV customer that we want you to charge, in Kansas in the middle of the night because there's a lot of wind and it's cheap. Or in California, we want you to charge in the middle of the day because we have excess solar. And we're going to build a rate that encourages you to do that. Every customer can understand that. That applies to everything else, too. And I think we're sort of getting to the point where technology prices are coming down to a point where the consumers of means, everybody in this room probably could put a solar panel on their roof and a battery in their garage. The consumers with means can buy technology around Consumers without means are going to be stuck with a lot of costs. And at some point, we have to, I think, make a movement towards marrying up the prices that consumers see, even if it's simplistic movements now, in the expectation that what's the grid look like and pricing look like 10 years from now or 15 years from now. But that's always been an area, and I think the consumer advocates, my members, very much have avoided this conversation because we like great, simple, and we don't want people to think about it too hard. And of course, we're worried about grandma not being afraid to turn her air conditioner on in Chicago in the middle of a heat wave. And those are all legitimate concerns, but that also encourages real inefficient use of resources, which is not good for anybody. It encourages, I think it encourages a lot of sort of subsidization intra-class and interclass. And so those are, it's a retail level discussion. It's not necessarily the market, but it's going to show up in the market because the prices come from there. And I think, I'm trying to move my association down that path to start having that discussion and try and get better policy and start thinking that through. And I think it's a big area that we need to be moving towards now.
I very much agree with David about that. And in fact, one of our most popular plans in Texas that TXU Retail has is free nights and solar days, because it encourages customers to use energy at the time of day when there's less, burden on the system. But those, I'm going to sound like a broken record here, but those kinds of plans are not possible unless you have a robust, competitive retail market. And that's the reason, that's the talking point we use when we go to talk to other states about opening markets or making them more competitive, is if you want customer innovation, you've got to have competition, because otherwise companies are not incentivized to create those kinds of products. And I do think this is, though, very directly related to the conversation about customer education, which we talked about a little bit, which is really hard, but we can't give up on that. We have to find ways to simplify our industry and simplify the learnings for the everyday consumer so that they will start to do things that can reduce their demand and make their use more efficient.
Yeah, absolutely. We have just a minute left, but Commissioner Diane Berman in New York sent in a question earlier that is somewhat interesting. But what specific guarantees should policymakers provide/demand as necessary for New York or other states to ensure that the energy transition will not result in reliability issues or reduced reliability? I'm not sure what you might consider to be appropriate. In some ways, I feel like there are already grid operators to guarantee it to some extent, but.
Well, if you recover everything, then the lights stay on. So that's one way to do it. The other way to do it is to do what EPA has done with environmental regs, and that is to have a safety valve if you're not going to hit your number. So if there's something that happens on the system that prohibits it, and it's not the fault of a specific actor, then you have to have some sort of market safety valve, because I don't see recovering everything as a practical outcome.
Mm-hmm. I think you need a real carrot and you need a real stick. And if they deliver, you got to be acceptable that they're going to get the carrot and give them the carrot. And if they don't deliver, they have to be recognized they're getting the stick.
Yeah, I would say standards, make them, enforce them. One of the challenges I always see is that there's such a turnover in regulatory commissioners. And commissioners are nice people, but they tend to be pleasers. Like, they don't want to say no, and they don't want to say a bad thing if they don't have to, if you don't push them, except Todd, of course. I think at the state level, I think commissioners can be a lot more, and I've worked under a lot. I've worked under 28 commissioners in Kansas and then been doing this for 30 years. So commissioners can actually enforce rules, and I think half the time, the things that we're fixing are the things that the prior commissioners didn't fix, right? They had an opportunity and didn't. So be strong, commissioners, it's up to you.